You're watching Startup Central with me, Nayantara Rai. For a while now, we've been hearing about how there's a need to bolster domestic capital for India's startup ecosystem to make it truly Atmanirbhar, to prevent flipping. We've also been hearing how these are the future engines of growth. As we speak, Zomato has already filed a draft red herring prospectus for a $1.1 billion IPO. Paytm is expected to debut on the Lal Street with India's largest IPO. You've got others in the works, whether it's a Nykaa, whether it's a Policy Bazaar. What you're also seeing is it enhanced interest by family offices and the richy rich to invest in tomorrow's engine of growth. I would like to now introduce my next set of guests who will be talking about a report that has been put together by 256 Network as well as Praxis. Joining us now is Madhur Singhal, the CEO of Praxis Global Alliance, and Siddharth Pai, the founding partner of 314 Capital. They've also contributed to this report. Thanks, guys, for joining us on this edition of Startup Central. Madhur, I'll come to you first. Very interesting report. I want to understand how you're estimating $30 billion by 2025.
Yeah, so, see, the number of HNIs and UHNIs in India are growing quite rapidly. You see a lot of interest from the traditional business houses, corporates, a lot of, older age entrepreneurs who now are becoming very open to the new asset class around private equity and venture capital. So you have a lot of old money, which is sort of seeking new investments, digital investments, also investments in private companies, which are faster growing typically than the businesses that have been publicly listed. The second part of the growth is in a lot of new wealth that's getting created. You're seeing a lot of wealth getting created from digital entrepreneurs, digital executives who are accumulating wealth at the back of startups and other faster growth businesses that they are a part of. You will see a lot of ESOP encashments, a lot of stake sales, a lot of younger wealth. That is really very open-minded about the PE, VC, angel investing type of alternative asset classes. And so we've basically counted the number of UHNIs who would have investable surplus of more than $1 million or 7 crores in India, and assumed an allocation, a small allocation to private equity, venture capital, and angel investing, and come up with the $30 billion number.
Okay. Of course, all of this happening on the same day. We've heard how James Murdoch is reaching out to nearly a dozen, family offices, all of that. But Siddharth, we're also talking on a day when you've seen a dream exit for investors via Vinny Cosmetics. The 10-year-old startup selling a controlling stake to the private equity giant KKR. Yes, it's not a tech startup. It's not what you would consider to be new age, but it is a 10-year-old startup. It ruled in the hinterland with, for example, with its fog deodorant. So are you folks also just narrowing yourselves to what is considered to be the new age companies?
Not really, Nayantara. If you actually look at it, technology has gone from being the core offering of a number of enterprises to actually becoming another function that the enterprise has to encompass in order to survive in this new age itself. So we're going to see technology go from, I would say, being a vertical, being a standalone feature, to actually become a horizontal feature itself. So it becomes ingrained in each and every part of the entire supply chain, as well as all the business operations. If you look at Vinny Cosmetics as well, even though you may consider them as an old world startup, the fact that they've actually used tremendous amounts of technology as well as digital services in their offering, I've actually allowed them to expand their margins, to actually lower their costs, and to actually start penetrating deeper and deeper into all these markets that were previously considered untappable from that perspective. So we've seen the convergence of intelligence, technology, as well as data analytics actually merging and revitalizing and changing every single business around. So I don't really foresee this as a battle between the old age and the new age. There is anyone who actually holds on to this particular mindset can no longer survive in this new hybrid age, as all of us have actually seen. So we've seen the thesis in terms of the old age industries, the antithesis in terms of the new age technology-driven industries by themselves. But if anyone actually reads Hegel, the great philosopher Hegel, everyone's now going to see the synthesis of these old world learnings as well as new world technology companies. And the fact that Indian family offices, as Madhur mentioned, are also going to start investing heavily into this. This goes to show that they've also seen the writing on the wall. They've also realized that no longer can a brand name or their deeper penetration into a market actually become a moat that can actually prevent all these new age businesses and these new entrepreneurs actually coming and taking over itself. We've seen that happen with Fog. We've seen that happen with everyone else. So they started diversifying away from this particular mentality, and participating in the VC ecosystem in India as well as Indian startups becomes the first way in which they can truly understand this digital transformation that's going through the entire world and become partner with all these new age entrepreneurs who are also up and coming as well.
Okay. And of course, change is the only constant. And Madhur, let me come back to you. You began this, and Sid has also picked up on it, that how the older generation is also understanding that these are the future engines of growth and recognizing it as an asset class. But Madhur, before we get ahead of ourselves, it is still a very, very risky asset class. You only hear about the success stories. The failure rate is still, of course, very, very high. So how are you seeing this take place? The family offices will make small investments across a bunch of startups, and that way you'll offset the potential losses too.
The risk is a good point. See, the risk is inherent in the venture capital or even the pre-venture seed stage or angel investing type of models. Most of these funds make money on 10 to 20% of their investments. 80% of the investments, do see either not so attractive financial returns or even some degree of mortality in the startups. That's just how the model is. Of the 10 investments, if you take risk, 2 or 3 of them, give you 10 to 20 times of the money you put in, that is actually sufficient to not only recover the capital that you put in the portfolio, but also generate a very healthy IRR, a very healthy return for your investors and for the family wealth. So, while the risk is there, at a portfolio level, the selection of the businesses on the entrepreneurs can enable you to actually create almost supernormal returns as well if you do a good job of asset selection.
Can I ask you one question, Madhur? That is that, when you've come up with this figure, you're projecting $30 billion of investments by 2025, all of that. Have you figured out what kind of startups? Like SaaS is extremely hot right now. EdTech was the flavor of the season last year because of coronavirus. Before that, you've seen e-commerce companies. Have you been able to figure out what it is that family offices want to invest in, what kind of startups?
Yeah. So I think the family office interest, spans across the board. Apart from the EdTech, software as a service, and some of the other names that you took, I think a lot of investment into all kinds of B2B commerce and vertical commerce models, especially given that a lot of the families have a lot of strategic value to add some of these businesses. Also, a lot of health tech, a lot of experience that some of the family offices have around traditional business models. They're also owners of significant infrastructure and assets. For example, in healthcare, if somebody owns hospitals, nursing homes, specialty care units, et cetera, you actually have a lot of strategic value to add to these businesses versus a venture capitalist who's only a financial sponsor. So you should expect a lot of money also going into B2B commerce. I should expect money going into vertical commerce and social commerce type models. I should expect money going into online content and media, and also expect money to go in health tech as well, because we do believe that health tech will have its edtech moment in the next 2 to 3 years.
Health tech should have already had its EdTech moment during a pandemic. But Madhur, thank you so much for joining us in this edition of Startup Central. Siddharth Pai, I request you to stay on. We are going to be breaking a story right here on ET Now. My colleague Karishma Asudani picking up that in the next 24 to 48 hours, you're likely to see new rules coming in for e-commerce companies. The idea being that any e-commerce company that wants to do business in India will have to register in India. Not only that, they will need grievance officers. Grievance officers, of course, being a very hotly contested issue between social media and microblogging site, Twitter, and the government. But this time around, it seems the government wants the e-commerce companies to be also very clear on who the grievance officers are. The names need to be highly published on the sites, mobile app, all of that. Karishma Asudani joining us live. Karishma, these are going to be amendments that are going to be introduced. You're picking up as far as the Consumer Protection Act 2020 goes. The idea, of course, being to give more protection to consumers vis-a-vis e-commerce. What exactly are you picking up?
Well, right, Antara, but these are going to be few stricter norms that I'm picking up from my sources for e-commerce companies. The draft has been circulated across departments. The preparations have been for quite some time. And if you remember, last year, we were talking about the country of origin factor that had come in. And now sources tell us that there could be few more aspects added to the country of origin part. One, which talks about that e-commerce entities may have to, likely provide ranking of goods, identify country of origin as one of the new amendments. And the most important, I think, that you also mentioned was about certain more details on the grievance officer that have to be published, mandatory on every e-commerce platform's website, social media, so that consumers can easily contact them. Besides them, you're expecting amendments that will come in around, that their registration part, their liability part, and also in terms of dealing with enforcement agencies or any kind of any such legal collaborations that the government is looking into. In fact, I'm also learning that every e-commerce entity will have to provide a fair opportunity for domestic goods, and government may notify certain kind of rules and amendments under that besides the country of origin.
Right. Siddharth Pai, the story breaking on ET Now, what do you make of it? We've known for a while the government wants to regulate e-commerce. No regulator, but just looking at ways to give some more rights to the consumer, it seems.
I think e-commerce is one of those areas where the laws change almost, the laws actually change more often than the business models actually do. We've seen numerous regulations actually come out in this particular space, with the country of origin regulations being the latest one in the mix. I think the change that's happened as of now is something, it's not entirely unexpected. Ever since the digital intermediary regulations came out in February of this year, I think everyone's actually waiting for every single digital intermediary platform to actually have similar notifications to come out in that regard. The fact that e-commerce has actually been the next business model or the next sector to actually see these particular changes is of no surprise itself. I think these particular changes in turn with the grievance officer, if you actually examine it closely, these actually resemble what the offline e-commerce players already have. If you look at any of the FMCG players or any of the other stores, etc., most of them do actually need to have a compliance officer in place, a grievance officer in place, and the fact that any grievances that actually come up to them need to be notified to FSAI and the other regulators as well, and from that particular matter need to be addressed in a time-bound fashion also. I think most entrepreneurs as of now are prepared, as these models actually in their maturity is whatever rules actually apply in the offline space or to their competitors in the physical space, the same rules are going to apply to them in a digital manner itself. So a number of startups now in India have actually become proactive in this regard. They've actually studied the extant regulations that apply to other industries, and they're trying to figure out as of now which of these particular regulations may apply to them and looking to become forward compliant in that regard. So the new intermediary guidelines that came out in February are actually going to be, I personally believe, are going to become the benchmark for a numerous number of changes in terms of a grievance officer for most of the digital online transactions that you can possibly think of. So it would become e-commerce. We've already seen social media go down the same route itself. And now with the Data Protection Act that's going to come up, we're actually going to see similar kind of rules come into other social media companies, SaaS companies, EdTech companies, and basically any other company in the online space that actually deals with any sort of personal data or actually engenders or creates transactions between various players. So the regulations are finally catching
Right.
up now. This may be the first,
Got
but
it.
it's definitely not going to be the last, according to me.
Right.